The fallout of COVID-19, skyrocketing inflation, climate change, and the conflict in Ukraine have all contributed to Europe experiencing an historic energy crisis. How do we get to this state? And what can you do to profit from the crisis? In 2021, Europe began to have some energy supply issues. During the winter, the EU often imports liquefied natural gas from the United States, Latin America, and Russia. However, power system problems in Texas restricted liquefied natural gas cargoes over the winter, and the 2020-2021 winter was colder than typical. Later that summer, heat waves swept over the United States and Europe. Droughts also hit Latin America, resulting in less of the essential hydropower required to transport LNG to Europe. As a result, according to the International Energy Agency, the EU increased its gas consumption by 25%, causing energy prices to skyrocket due to a scarcity of supply. In addition, due to less than ideal wind conditions, Europe also had below-average volatile renewable energy generation, particularly in wind power. According to the European Union Institute for Security Studies, this increased demand for energy imports. The EU is also largely reliant on Russian gas imports. While the country has met its contractual obligations, Moscow claims that wildfires and COVID-19 have hampered delivery. Europe's situation was compounded by the war in Ukraine and the pandemic's continuing impacts, which contributed to high inflation rates and increased energy prices. However, there is suspicion that Putin has been using its energy as a weapon against the EU as a result of its support for Ukraine in the war, leaving Europe to wonder whether they genuinely have fewer supplies. There is no single shred of doubt that the energy crisis has strained Europe. This summer, Europe saw a record-breaking heat wave in the middle of an energy crisis. European countries have been asked to reduce their energy use by 15%, while Russia has limited its energy supplies because of the war. The EU wishes to conserve energy in preparation for the coming winter, which will boost energy demand for heating. Climate change is causing record warm summers and cold winters, which means these dichotomies will certainly get more extreme. Even if things are bad now, these could be golden times for Europe. Europe's energy sector has never been more fragile due to increased demand. The summer warmth also hampered the EU's ability to generate its own renewable energy. High temperatures were incapacitating for hydroelectric sources, while signs of incipient stress corrosion, cracking, and maintenance forced the shutdown of 32 nuclear reactors in France. The irony is that West Europe's phase-out of nuclear power compels it to rely on fossil fuels like gas and oil, which increases emissions and worsens extreme weather. Along with deteriorating physical conditions, the price of energy has grown as a result of the pandemic recovery and the war. According to the New York Times, the wholesale price of megawatt-hour electricity reached a record high of £500 or $590. Governments have tried to offset the burden by providing households with financial assistance to help pay utility bills. Households are not the only ones who face increasing costs. Many European manufacturers are shutting down production lines due to the inability to pay power and utility bills. In July, European industrial production fell by the most in 2 years. Europe has entered crisis mode, spending even more money to ease the cost of energy on businesses. European governments have previously set aside around 500 billion euros to set a cap on energy expenses for businesses. To control costs, the German government even seized the utility business Uniper. German Economy Minister Robert Habeck said that the government will do everything possible to always keep the company stable on the market, but this is possible to be unstable in the long run. For the time being, Europe's outlook remains grim. Russian President Vladimir Putin's decision that he would mobilize more soldiers and threaten nuclear strikes demonstrated that the battle in Ukraine is far from done, worsening Europe's energy dilemma. The situation has worsened to the point where EU authorities have called for voluntary energy rationing, which may later become compulsory. While a mild recession was initially forecast for 2023, Deutsche Bank now predicts a longer and deeper recession, according to Fortune. Europe's decades-long environmental and energy regulations have been a drag on the EU economy. Energy prices that are higher than the world average have resulted in economic and technological stagnation. This fall and winter, there is a chance that its energy and environmental policies may clash with a number of other global and regional economic factors to produce the ultimate energy crisis scenario. Moreover, an increase in oil prices this fall and winter might exacerbate an already alarming trend of energy price inflation. Much will depend on this fall and winter on Russia's willingness to supply extra gas to the EU to remedy the regional shortage. Suppose the situation does not improve in the coming months. In that case, there is a risk of a devastating economic crisis, followed by a socio-economic and political crisis that might derail the global COVID recovery. The first and most serious task will be European asset risk, followed by contagion effects on global markets. However, there are also opportunities, such as Gazprom, the Russian majority-owned international energy firm that now holds the key to whether Europe will face a winter collapse or not. But how can you protect your capital in these circumstances, or even profit from this disaster? Number 1. Choose your stocks carefully. The initial result of an EU crisis will be an outflow of capital from European markets, which will mainly wind up in the US, boosting US stock market prices. Investors who buy European stocks or funds that rely heavily on the European market for revenue are taking a risk now. Renault, for example, is significantly more reliant on EU sales than Daimler. Renault's risk is thus possibly more immediate and greater than Daimler's. But some US and other assets will eventually suffer a decline due to contagion effects, such as a decline in exports to the EU, while businesses that create and sell goods and services in the EU will suffer greatly. As a result, the global investment climate will eventually suffer as a result of an EU-wide crisis, even if financial withdrawals would first appear to be a good thing that will bolster key alternative markets. Number 2. Invest in the energy sector. Buying energy companies' assets right now is a very bullish move. For example, the Energy Select Sector SPDR ETF increased approximately 52% from December 31st, 2021 to mid-June. In comparison, the S&P 500, Dow, and Nasdaq each fell roughly 22%, 16%, and 31% respectively. On the other hand, Western LNG suppliers may not gain as much as we see with Gazprom, particularly in terms of stock performance. This is because long-term investors are frightened about the impact of green initiative penalties on their longer-term perspective, and they're taking advantage of any upward momentum to exit their assets. Shell has recently been a prime example of this trend. Cheniere may have a better chance because it is all about LNG exports and may be able to avoid ecological action to some extent due to its low corporate profile outside of the investment community. Its only issue may be the rising cost of US shale gas, given that the fracking boom has largely ended. Number 3. Buy Chinese chemical company funds. Due to the EU crisis, Chinese chemical companies are in a good position to grow. EU businesses are currently facing a tough time, and the Russian-backed chemicals industry in Europe is in no position to grow anytime soon if solutions are not found. China has been the largest chemicals producer, but the EU has been a good contender. China has more room to make headway, and so do the related stocks. Aping in on the Chinese chemical industry ETF run by the Yinhua Fund Management could be a big move if you are into chemical stocks. Earlier this week, the fund gained more than 3.5%, while state-owned Sinochem, which manufactures industrial and agricultural chemicals, had its stock rise more than 10%. Number 4. Be cautious when investing in euro currency. One final point to mention is the impact of such a crisis on central bank choices. The ECB will have no choice but to allow inflation to grow further in order to avoid a debt crisis, as national governments would be forced to spend more money to address the resulting social ills. In other words, it will maintain its expansionary monetary policies, causing the euro to fall. Most competitors and partners will need to follow suit to keep their respective currencies from becoming overly strong compared to the euro, which would harm their exports. The eventual outcome might be irreversible global inflation. On the one hand, this will boost stock values in nominal terms, When adjusted for inflation, an economic crisis, on the other hand, will have a dampening effect on the real worth of revenues and profits. In general, look for industries that will be majorly affected by the crisis, either negatively or positively. Then, buy the stocks of companies that will grow as a result and short those that will take the fall. If you're looking to focus on the EU alone, then you could make some good gains shorting major industries since they are starting to go down. While these look like solid predictions, be encouraged to do your own research. Now, will you take the risk? What is your plan to come out of the crisis unscathed or even richer? Let us know in the comments. We will appreciate your helpful ideas. So, subscribe to Ape Finance, and we will see you in the next video.